Welcome to TaxLawGH and welcome to our video on pensions in Ghana and Ghana's three-tier pension scheme. In this video, we'll take you through quite a lot of material that will make sure you understand how pensions work in Ghana and to a very large extent give you a very great appreciation of the key principles and concepts you need to know. They say history is important. If you're interested, just hit the pause button and read. But key takeaway from here is that in 2008, our new Pensions Act of 2008 Act 766 was passed by the Parliament of Ghana. On the 1st of January 2010, our three-tier scheme was launched and became effective. In 2011, two pieces of subsidiary legislation known as legislative instruments were passed by Parliament to aid the effective implementation of the main act, which is the Act 766, our Mother Pensions Act in Ghana. And then also know that in 2014, December, Act 766 was amended by Act 883 to introduce some new provisions relating to pensions in Ghana. We'll find out all of these shortly. Like I said, for the history, if you're interested, just hit the pause button and then read through. So, still on history for those who are interested. Let's come to why we are here. What is the objective of the pension scheme that was introduced in 2010? We're saying that it had three main objectives really. The first was to provide pension benefits to ensure retirement income security for workers in Ghana. The next was to ensure that every worker received retirement and related benefits as and when they were due. And third, and actually very important, was to establish a uniform set of rules, regulations, and standards for the administration and payment of retirement and related benefits for workers in both the public and the private sector. Who did this pension scheme cover and who was exempted when it was introduced? We are saying it covers all employees in the formal sector, including but not limited to any establishment where there is an employer-employee relationship existing. The next is workers who fall under the informal sector or the self-employed were also covered by this new pension scheme. Then, as at 2010, employees who were 50 years and below were mandatorily covered by the scheme. Then, at the time, as at 1st January 2010, those who were above 50 years of age, it was optional for them to be on the scheme or not. Those who are exempted are officers and men of the Ghana Armed Forces and any other person who is expressly exempted by any law, most likely the Constitution of Ghana. Now let's come to the three-tier scheme of Ghana. We are saying that the pension scheme, I've already said this, has three main tiers. What are the tiers about? The first tier, as we'll find out, is the basic national social security scheme for all workers in Ghana. This is a defined benefit scheme number one, and it is mandatory for all workers to have contributions made on their behalf. All tier one contributions are managed by the Social Security and National Insurance Trust of Ghana, which is, I'll be calling SNIT going forward. Now, it's a defined benefit scheme. Remember, I've said this, and it is mandatory. The second tier is a defined contributory occupational pension scheme, which is also mandatory, and it's for workers who have contributions made on their behalf. Key thing to remember is that the contribution under the second tier will be managed privately by approved trustees. The third tier will include all provident funds and other pension funds which are outside tier 1 and tier 2. But key thing to take away from here is that tier 3 is a voluntary scheme. It's not mandatory. You can choose to contribute to a tier 3 scheme or not. It's quite voluntary. In summary, what are we taking away from here? Tier 1, or the first tier, is a mandatory basic national social security scheme managed by SNIT. Tier 2 is a mandatory, also fully funded and privately managed occupational pension scheme. The third tier is voluntary, also fully funded, also privately managed just like tier 2, and it's a provident and personal pension scheme. So remember, first tier, second tier, mandatory, third tier, voluntary. Now that we know what the tiers are, which ones are mandatory, which ones are voluntary, how do we contribute to pensions in Ghana? In simple terms, we are saying an employer is required to deduct 5.5% of an employee or a worker's basic salary And then the employer makes a 13% matching contribution of the same basic salary. What do I mean? If an employee earns a basic salary of, say, 1,000 cedis, the employer will deduct 5.5% of that 1,000 cedis from the employee's salary before paying the employee. So it means the employee contributes that from his own basic salary. And then the employer funds themselves 13% of that 1,000 cedis and then adds it to the employee's 5.5% to make 18.5%. It is this total of 18.5% that is going to be split later, as we'll see when it comes to the mandatory pension tier. So remember, this 18.5 is for the mandatory ones. The voluntary one, because it's voluntary, it's not really covered under this split. So remember, the employer deducts 5.5% of the employee's basic salary, and then the employer tops up with that themselves with a matching contribution of 13% of the basic salary. That'll give us 18.5%. So you can see we've summarized at the bottom here that employee brings 5.5%, the employer contributes or tops up with their own 13%, and this gives us 18.5%. How is this 18.5 split? I'm saying here that out of the 18.5% total contribution, 13.5% is paid to SNIT. Remember, I said SNIT manages the first tier of Ghana's pension scheme. And then the remaining 5% out of the 18.5% is paid to a private fund manager of the employer's choice. Remember, I said the second tier is also a mandatory scheme, but privately managed. So 5% of the 18.5% goes to these private fund managers. And then remember, I just said that 13.5% is paid to SNIT. Out of that 13.5%, it is sub-distributed. So out of the 13.5% paid to SNIT, SNIT then pays 2.5% to Ghana's National Health Insurance Authority as a way to fund health insurance in Ghana. And then the remaining 11% is managed by SNIT to properly undertake their Tier 1 pension management activities. So in summary, we are saying here that, remember we said employer deducts 5.5% of the employee's basic salary. Employer makes a matching contribution of 13%, total 18.5%. This 18.5% is then split. 13.5% goes to SNIT, 5% goes to the second tier private fund manager or private pension trustee. And then out of the 13.5%, SNIT pays 2.5% to Ghana's National Health Insurance Authority, and then the remaining 11% is managed by SNIT to pay pensions. Remember this. Now that we know this, let's look at the tiers in a lot more detail. Let's look at Ghana's first tier. Remember I said the first tier is our basic national social security scheme. It is mandatory for employees in both the public and private sectors of the economy, kind of optional for the self-employed, and it's administered by the Social Security and National Insurance Trust, SNIT. Remember, the governing board of SNIT is a board of trustees with a balanced representation of employers, employees, and government. Minimum age for membership is 15 years, and the maximum age is 45 years for new entrants. So if you're older than 45, you would have exceeded the maximum limit for joining the SNIT pension scheme. And it's because of something I'll tell you very soon, which is the period you have to contribute on a minimum basis to get pension contributions or pension benefits when you retire. I'm saying here too that the minimum contribution salary is based on the national daily minimum wage, which is set frequently on an annual basis, adjusted in line with economic conditions and all of some other factors, and a maximum salary to check abuse of the system. So currently it is pegged at 25,000 Ghana cedis basic salary on a monthly basis. So remember this, very, very important. And then under the first tier, there are a number of benefits that are available for retiring persons or retiring pensioners. The first is known as a superannuation pension, or this is really like your old age pension. This is what you are paid when you've actually gone on retirement. There are two main types of this. You can either get a full pension payment or a reduced pension payment, and we'll look at how to compute this subsequently. Invalidity pension is usually or typically paid to people who have lost the ability to continue being in employment. So if for some reason you are a victim of some permanent physical or mental disability and you are able to prove that you're unable to carry out working, then you'll be paid an invalidity pension. The immigration lump sum was introduced by the Amendment Act I mentioned earlier at the beginning, and it's really for persons who are non-Ghanaians who have contributed to our pension scheme and are leaving Ghana for good. They are paid a lump sum on their way out of the country. Survivor's lump sum is where, in the unfortunate event that you die before your time, you'll be paid, or your dependents or the persons you nominated as your beneficiaries will be paid a lump sum because you've contributed to pensions in Ghana. Let's look at the superannuation pension in quite a lot more detail. We are saying this is paid to a member who has met the minimum requirement of 180 months or 15 years in aggregate contribution. Remember, this is why, for some reason, the maximum entry age has been pegged at 45 years old or 45 years of age for Tier 1, because you need to contribute for a minimum of 15 years or 180 months to actually enjoy superannuation pension. So why not just peg the maximum entry age at 45, because the statutory retirement age in Ghana is 60 years anyways. So we are saying that this is paid to anyone who has met the minimum contribution period. They've made contributions to SNIT on a month or a periodic basis at a minimum for at least 15 years, and they are 60 years of age. When you retire at 60, you get something called a full pension. When you retire at 55 years and above, that's you go on early retirement, you get something called a reduced pension. How is the superannuation pension calculated? I'm saying here that there are certain parameters that go into determining how much your pension will be. Three main factors. The first is the age at retirement. How old were you when you retired? So this will contribute to a factor I'll call the early retirement reduction factor. Then the next is your earnings or your salary on which your contributions were paid. Remember, I told you that your pensions are contributed on your basic salary. So here I'm saying that your earnings or salaries on which your contributions were paid, this will translate into a metric we'll call the average of your 3 best years' salaries or annual salaries. Then the final is the number of months you made contributions, which is known as the pension, right? So obviously, if you make a lot more contributions, then there will be a weight that will feed into how much your annual pension will be. So to calculate your annual pension, we take your average of your best 3 years annual salaries. So you may have contributed for 20 years, but we take the best 3 years and find the average. And then we multiply this by the pension, right? Remember, I said this relates to the number of contributions you made or number of months you contributed. We'll translate into a metric. There's a way to look at that, I'll show you. And then we multiply this by your early retirement reduction factor. For someone who retired at 60, this will not have an impact on their computation. For those who retired at 55 and above, then there will be a significant, not too big, but a change or a hit on how much you get as your annual pension. Whatever I get here, you divide by 12, that will determine what will be paid to you on a monthly basis as your pension. For a detailed computation on this, we'll look at another video which will look at computational aspects of all of this. But for now, let's move on to the invalidity pension. So if you want the computation, please stick around for our subsequent videos on this. Then for the invalidity pension, remember I mentioned earlier that this is paid to someone who has incurred some form of permanent physical or mental disability. So here, it's paid to a member who is totally incapable of earning a living through working because they've been permanently physically or mentally disabled. But here, before you are paid this, you should have contributed for at least 12 months within the last 36 months. What do we mean? So I'm saying before the occurrence of the invalidity, before the occurrence of the accident or whatever caused you to permanently be unable to work, again, whether by way of physical or mental disability, you should have at least contributed for within the past 3 years, you should have contributed for at least the minimum of 1 year. So within the past 36 months before you became invalid or you became disabled physically or mentally, you should have contributed for at least 1 whole year minimum. And then there must be some proof by a medical board that indeed you are incapable of any normal gainful employment. So obviously all you need to do is walk to a certified medical board and then let them certify, give you any written proof that indeed, after examination, they acknowledge or they certify that you are unable to carry out any meaningful employment, so you have become invalid, and because you are invalid, SNIT will pay you your invalidity pension payment. Then immigration lump sum, like I mentioned, is paid as a lump sum, huge one-time payment to non-Ghanaian members who are leaving Ghana permanently. But they must submit documents to indeed prove that they are leaving Ghana for good and they are not coming back. They'll be paid all their pension contributions when they are leaving Ghana. The next is survivors lump sum and qualifying conditions. So here, this is paid as a lump sum to your nominated dependents when you die whilst in service. That's whilst you're in active employment or when you're on pension. But remember that if you die after the age of 75, your dependents don't get any survivors lump sum. This is based on actuarial calculations and assumptions, and we know that at 75, maybe it's normal to die. So anyone who dies after 75 will not be paid any survivors lump sum. But if you die before the age of 75, your survivors who were nominated by you on your SNIT and records will be paid a lump sum. So either you die before retirement or after retirement but before 75, you will be paid a survivors lump sum payment. Let's look at the tier 2 or the second tier scheme of Ghana's pension system. Under the second tier, remember I said this is also mandatory, but it is privately managed. So tier 1 is mandatory but managed by SNIT, which is a government institute or trust. Here we are saying that tier 2 is mandatory, privately managed, and the whole idea is to give contributors a lump sum benefit to replace what was previously available under the SNIT scheme or the Cap 30 scheme as it was called back then. So here, whilst tier 1 will pay you a monthly pension and the other benefits I mentioned, superannuation, immigration, survivors, and invalidity, tier 2 is really here to pay your lump sum benefit when you're retired. What goes into determining your lump sum benefits, saying here, is dependent on a number of factors such as the level of contributions, the investment returns made by the fund manager, and any administrative expense they incurred in managing the scheme. How is the tier 2 operated? Like I said, it's operated under trust by trustees who have been approved and licensed by the NPRA, which is Ghana's National Pensions Regulatory Authority. Accrued benefits are preserved until retirement age, or earlier withdrawal is possible under certified condition of physical or mental disability. So like I said earlier, here to be able to prove that you are unable to continue working, you can be paid your benefits before pension. But unless that happens, typically this is preserved until retirement age until you die. And here, remember that this can be transferred to another occupational scheme during change of employment. Because your employer has the choice to choose who to or which fund manager or pension trust can manage their tier 2, when you change employer, you can obviously transfer your contributions or your account to your new employer's pension fund manager. So this is a transferable scheme because of the flexibility given to you to change your fund manager on an employer-to-employer basis. The next is that remember that on retirement or earlier death, the benefits will be paid out to you as a lump sum, one huge payment. Early withdrawal is permitted if the contributor is unemployed at a minimum age of 50 years of age or on the grounds of total permanent disability. So remember that here, you can withdraw early, but you should be able to prove that you're unemployed at a minimum age of 50, or either you are totally and permanently disabled, whether it's physical or mentally. Remember this, very important. What else do we need to know under the second tier? The accrued lump sum under the second tier, good news, can be used as collateral to secure mortgage in Ghana for your primary residence. Contributions to the scheme are also exempt from tax, as well as the income accruing from investment of the scheme funds also being exempted from tax in Ghana. Any non-Ghanaian citizen who does not satisfy the qualifying conditions to get their pension payment, but a desire to leave Ghana permanently, can have access to their entire accrued payments in a lump sum. It's only fair that if they contribute and they are leaving for good, we give their money to them as they go back to their home countries. Then I'm saying also that on the death of a member, the whole of the member's accrued benefits will be paid as a lump sum to the members' nominated beneficiary. So this is where people will advise you to make sure that whoever you have nominated as your beneficiaries, you review this on a frequent basis to ensure that if you now have children, then you need to find a way to put the children there. Let's say you joined the pension scheme before you had children, so you didn't have any beneficiaries. That was probably your parents. You need to review this on an ongoing basis to ensure that you have up-to-date beneficiaries in case the unforeseen happens. The third tier is what we'll look at next. That's the voluntary one I talked about earlier. Under the third tier, we're saying this is a voluntary, fully funded, and privately managed scheme. It is supported by tax incentives up to a maximum of 16.5% of the contributor's salary to provide additional funds for workers who want to make a voluntary contribution to enhance their pension benefits. Once again, the minimum age for membership is 15 years, but however, it's allowed for a contributor who is more than 60 to still be a member. So remember, there's a difference between this and the mandatory schemes. Here, if you're older than 60 and you still want to contribute to the third tier, feel free, you're welcome. That's the whole plan here. Also, we are saying that anyone who has attained a retirement age is entitled to their accrued benefits in a lump sum payment. Remember this, very important. A member who has not attained a retirement age may withdraw all or part of their benefits after 10 years from the first date of their first contribution or following a medical certification that they are incapable of any normal gainful employment because they become physically or mentally disabled. We are seeing here also that the beneficiaries of a deceased contributor may withdraw the accrued benefits from the scheme should you die. Then, similar to the other schemes, any investment income from the investment of scheme funds would also be exempt from tax, income tax, how to be clear. The scheme applies to individuals also in the informal sector. So this is really where most of them will end up anyways because of the way they do not have an employer-employer typical relationship. So who are not covered by any pension scheme under the mandatory first two tiers. This scheme also applies to individuals who on their own want to make voluntary contributions to enhance their benefits when they retire outside the first two mandatory schemes. A worker may join the scheme if they are more than 15 years. We've said this already. Then here, any contributor who is self-employed in the informal sector, who is not covered under the mandatory, will have his or her contributions credited in agreed proportions to two separate individual sub-accounts, which we'll call the personal savings account and a retirement account. Remember this, a personal savings account and a retirement account. Then a contributor is allowed to withdraw part of the accrued benefits in the personal savings account, but the proceeds of the retirement account will only be paid upon retirement as either monthly or quarterly pensions. Then if you are in the formal sector and you've attained the retirement age, which is in Ghana is 60 years of age, you're entitled to the entire accrued benefit in a lump sum payment. If you have not attained the retirement age, I said this earlier, you may withdraw all or part of your accrued benefits after 10 years from the first date of your first contribution if you're in the formal sector. Those who are in the informal sector can withdraw after 5 years from the first date of their first contribution. So remember this 10 years for those in the formal sector, 5 years for those in the informal sector. Now I'm saying also that if you are permanently disabled, physically or mentally, you can withdraw all or part of your accrued benefits. When you die, your beneficiaries can also get access to your benefits in the scheme. Key thing here is the tax treatment of withdrawals when you are making withdrawals when you either met the 10-year period or the 5-year period, either you're in the formal or informal sector. So I'm saying here, persons in the informal sector who are not covered by the mandatory scheme shall have 35% of their declared income exempt from tax for contribution purposes. Remember, this is similar to those in the formal sector. They have 18.5% going to the tier 1 and 2 really or realistically, then an extra 16.5 making 35% total, all being available to tax benefits. So here we are saying that if you're in the informal sector, then we also give you your whole 35% of your income can go into this contributory scheme and be exempt from taxes. And we are saying that if you withdraw all or part of your accrued benefits in the third tier after retirement or on retirement, that's when you're 60 or after, then this is totally tax exempt. However, if you withdraw, I said formal sector, before 10 years and before retirement, then a 15% withholding tax or 15% final tax will apply. So if you are contributing to the third year and for some reason you need your money, you would be subject or liable to a 15% final tax if you withdraw before 10 years and before retirement. Those in the informal sector have a reduced period of just 5 years. So if they withdraw before 5 years and before retirement, then they are also subject to the 15% tax. I'm saying the tax exemption status applies for cases of incapacity or death. So when you die and your beneficiaries are getting the money, they do not pay the tax because it's sad news, you've died. Same for invalidity. When they are paying the lump sum, you don't suffer the tax because you did not make a voluntary claim, whilst you could still contribute. What has COVID-19 introduced when it comes to the treatment of the taxes when you withdraw from the third tier? Act 1017 amended Act 896, which is our Income Tax Act of 2015. What Act 1017 did really was to exempt from tax any withdrawal from the third tier as a result of COVID-19. So what are we saying here? If because of COVID-19 you permanently lost your job, or a self-employed person needed funds from their third tier because of COVID-19, then this would be exempt from tax. Remember the 15% tax on withdrawal in the case of COVID-19 withdrawals may enjoy some tax exemptions and not suffer the 15% final tax. So now let's look at some supervision or regulation matters needed under Ghana's pension scheme. Key thing we need to look at here is the function of the National Pensions Regulatory Authority of Ghana. What are they required to do by law? They are responsible for ensuring compliance with the National Pensions Act, Act 766. They are required or they are responsible to register for the registration of occupational and personal pension schemes and provident fund schemes in Ghana. They are also responsible for the approval, regulation, and monitoring of trustees and service providers that deal with pensions. They establish standards, rules, and guidelines for the management of pension funds in Ghana. They also educate the public on matters related to the various pension schemes. They also receive and investigate complaints of impropriety in management of pensions in Ghana. What else do they do? They also receive and investigate grievances from pensioners and provide redress, help solve their problems. They also serve as advisors to the government on the general welfare of pensioners and on the overall policy of pensions or pensions in Ghana. They regulate and monitor the implementation of the basic National Social Security Scheme in tandem with the Social Security and National Insurance Trust, SNIT. They also promote and encourage the development of the pension scheme industry in Ghana. So by way of summary, what have we covered? We've covered a lot. What do I want you to take away from here? We have three main pension tiers. Tier 1 is a mandatory basic national social security scheme managed by SNIT. Tier 2 is a mandatory, fully funded, and privately managed occupational pension scheme. The third tier, or the tier 3, is the voluntary, fully funded, and privately managed provident and personal pension scheme. 18.5% is the total contribution. The employee contributes 5.5%. The employer makes a matching contribution of 13%. Out of the 18.5, we are saying 2.5%, or let's even do it this way. Out of the 18.5%, 13.5% is paid to SNIT. And then 5% is paid to the second tier private pension fund managers or trustees. And then out of the 13.5 paid to SNIT, 2.5% is paid to the National Health Insurance Authority for health insurance purposes. And then 11% is managed by SNIT for the Tier 1 pension system. So we hope this has been helpful. If it has been, please do not forget to smash the like button and to share this video within your network. We'll catch you in our next video.